sentiment changes, then that is one whole new wave of buying that will come in. And I think the central bank buying is going to continue, not at the same rate it did last year. I don't think that at all. I think we'll see this year. I think this year we'll see net buying, strong net buying, but considerably less than last year and the year before. But when we have a new wave of buying from Western investors, institutions and retail, then I think gold and silver both are going to move meaningfully this year. So where will we end the year? I don't know. I think we're going to be higher than we are now at the end of the year. And a lot depends on the dollar.
The latest World Gold Council's Q1 2024 Gold Demand Trends Report highlights a notable uptick in global gold demand. Total demand rose by 3% year-on-year to 1,238 tons, marking the strongest first-quarter performance since 2016. According to AdrianDay of AdrianDay Asset Management, recent months have witnessed a surge in gold buying, primarily driven by central banks and Chinese savers. Central banks have been significant purchasers over the past year, while Chinese savers are increasingly turning to gold as a safeguard against economic uncertainties and currency devaluation concerns. Despite this, gold exchange-traded funds have experienced outflows, with global holdings decreasing by 114 tons, mainly led by North American and European funds. However, there have been slight inflows into Asian-listed products, predominantly driven by renewed investor interest in gold amidst a weakening local currency and underperforming domestic equity markets, particularly in China. Day anticipates that central bank buying will persist, albeit at a slower pace compared to previous years. Additionally, they foresee a potential shift in sentiment among Western investors, potentially leading to a resurgence in buying from institutions and retail investors. In early U.S. trading on Friday, gold and silver prices rallied following a downbeat U.S. jobs report, aligning with the expectations of monetary policy doves who advocate for U.S. interest rate cuts by the Federal Reserve this year. Despite gold pulling back from its peak, it has demonstrated resilience by resisting significant drops and gradually reclaiming lost ground, indicating robust demand for the precious metal. A new price prediction suggests that gold prices may not surpass the $2,400 mark in May 2024. Forecast estimates indicate a potential bearish turn for gold this month, with a projected dip in value over the coming weeks, trading within the range of $2,163 to $2,227. Join us as we delve into insights shared by AdrianDay. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
As everybody knows, we went from 2,000 to 2,400 in basically 3 months. That's an astonishing move for an asset like gold, especially when the dollar was staying strong. So it wasn't caused by the dollar collapsing. For an insurance asset, a defensive asset, to move like that is really astonishing. We all know the reasons. I won't go into it. So we pulled back from the 2,400 level. We're now just above 2,300 as we talk. But again, that's not surprising given the move we've had. And I would characterize it as gold is really resisting dropping. It's dropped whether in Asia or in Europe or in the US. It's dropped in one of those markets and then slowly recovered, some ground. So it's really resisting dropping. And I think, frankly, that just speaks to the demand that's out there for gold. So what I see, the vast majority of buying in the last 3 months, but also in the last 18 months, but particularly, let's say this year, has been central banks and Chinese savers.
Right.
We shouldn't ignore the Chinese savers because, they're concerned about their economy, they're concerned about the yuan devaluation, and they're concerned about the fact that China might be introducing easing measures. And they're looking for a way to protect their purchasing power. And they're not going to put their money in the bank. They're worried about the banking sector. They're not going to put their money in real estate, which is where Chinese people traditionally have put their money. And they're not going to put them in stocks with the stocks as low as they are. Some of it's going into stocks. We've seen a rally in Chinese stocks in the last couple of weeks. But most of it is going into gold. they can't put it into Bitcoin, as you know, or cryptos, they're banned.
Right.
So most of it is going into gold. And when you look at those two buyers, they are driving the market. They have been driving the market. They have a vast majority of the buying that we've seen this year and central banks for last year.
Right.
When we see, as we will, when we see a shift in sentiment among Western investors, that's institutions and retail, which we haven't seen yet. Remember, we talked about this last year, the outflows from ETFs. We are still seeing more outflows from gold ETFs than we're seeing inflows, which, given what gold is doing, is really quite astonishing. We're still seeing very low premiums on coins and low deliveries from mints. So the demand among retail, among institutions is just not there. When sentiment changes, then that is one whole new wave of buying that will come in. And I think the central bank buying is going to continue, not at the same rate it did last year. I don't think that at all. I think we'll see this year. I think this year we'll see net buying, strong net buying, but considerably less than last year and the year before. But when we have a new wave of buying from Western investors, institutions and retail, then I think gold and silver both are going to move meaningfully this year. So where will we end the year? I don't know. I mean, you know, I don't know who it was. Was it Barnum or someone? WC Fields? I don't know. But someone said, if you're going to make a prediction, don't predict price and time. That's the thing about gold and silver right now, is the strength is in the face of a macroeconomic environment that should be negative for gold.
Right.
You know, a strong dollar, aggressive rate hikes and rates still high, and the Fed pushing back on cutting rates this year. So all of those things in a, quote, normal environment, or if you are only looking at the macroeconomic environment, gold should be falling and significantly lower than it is right now.
U.S. job growth experienced a sharper slowdown than anticipated in April, with the increase in annual wages dropping below 4.0% for the first time in nearly 3 years. However, it is deemed premature to anticipate interest rate cuts by the Federal Reserve before September, as the labor market remains relatively tight. AdrianDay highlights that alongside slow job growth, underemployment is increasing, indicating many workers rely on part-time or multiple jobs to make ends meet. This suggests a weakening employment landscape, signaling a gradual deterioration of the labor market. The latest employment report from the Labor Department noted a slight rise in the unemployment rate to 3.9% from March's 3.8%, attributed to the increase in labor supply. Despite this, the jobless rate has remained below 4% for the 27th consecutive month. However, data from the same week indicated a decrease in job openings in March. According to the Bureau of Labor Statistics, non-farm payrolls expanded by 175,000 jobs in April, marking the lowest monthly increase in 6 months. Additionally, revisions to previous reports showed 22,000 fewer jobs created in February and March than initially reported. Day expresses concern over frequent downward revisions in payroll reports, suggesting potential inaccuracies in the Bureau of Labor Statistics methodology or other factors. He highlights that these revisions often reveal a grimmer employment situation, complicating the assessment of labor market health. Let's get back to the interview.
Look at the jobs report today, the payroll report today. On the surface, yes, the number of new jobs was lower than expected, but you might say we're still generating new jobs. Wasn't so bad. But lift up the hood, and incrementally, everything is getting worse. The unemployment rate ticked up 0.1%, admittedly. And I can't help thinking Jerome Powell, when he spoke on Wednesday, Jerome Powell, the Federal Reserve head, when he spoke on Wednesday, he must have known what the unemployment rate was going to be,
100%.
because he said, you know, we're not going to be worried if it ticks up by 0.1%. Well, anyway, it ticked up by 0.1%. But then you look at other indicators, like the hours worked was down because of slack work, meaning companies have an employee, but they simply don't have enough work for them. So they work fewer hours. Plus 2 payroll reports They were revised downwards, which is a trick that the Bureau of Labor Statistics does fairly regularly these days, it seems. So
why did they revise them downwards?
Well, how do they revise them? Well, because they say they have more information. You know, the initial report is based on whatever information they have, and then they get more reports in and they analyze the data better, and they can revise downwards or upwards. It's not unusual to revise a prior month up or down, but what we've seen for the last, really for the last 12 months is we've seen 2 revisions. Last year, something like, so that's 24 revisions. Something like 21 of those 24 revisions were downwards. That's not a surprise. That's not a coincidence. It's either an indication that the Bureau of Labor Statistics methodology is inaccurate,
right?
Or if you want to be a conspiracy person, it's an indication of something more nefarious. But at any rate, it's definitely an indication that things are worse than the headlines first appear. And of course, I've said this before, when the jobs number comes out, everyone looks at the headline, and the first revision gets very little attention, and the second revision gets almost no revision. But both 2 months were revised downwards this month. Hours worked downwards. So you know, you have a lot of indications. Underemployment is up again. That was the other thing I was going to mention. So unemployment rate moved up 0.1%, but so did what they call underemployment, which is people working part-time. Employment picture, let's put it that way. The employment picture is not as strong as it appears. And I've said this before, you've got an unemployment rate, but if half your people who are employed are only working part-time or are working 2 jobs to make it, you know, to cover expenses, that's not a sign of a healthy employment picture. So the employment picture is a lot worse than it first appears. And the second point is that it is slowly deteriorating. But again, when you had all these handouts, particularly at COVID, handouts to individuals not to have to work, handouts to companies but got reimbursed for keeping employees on. Well, obviously, you're going to have
consequences.
It's going to take longer for those consequences to become apparent.
The current state of the global gold market and U.S. job growth highlights significant economic dynamics. Robust gold demand, fueled by central bank purchases and investor interest, contrasts with challenges in the labor market, indicating potential economic weakening. How might these trends impact overall financial stability and investor sentiment? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.